Well, let's get a quick macro outlook on 2025. Aurodeep Nandi is India economist at Nomura. He's joining us now to take some questions. Aurodeep, we'll get to specifics from your report in just a bit. But at a broad level, for our viewers, I mean, what matters is asset prices and financial markets. And that kind of mirrors what kind of activity you will see on the economy side. In 25, looking a little more, is it looking tougher as compared to the last few years? Let's just start there.
Yeah, I mean, look, we think that the Indian economy is in a cyclical slowdown as we speak, right? And in fact, for FY25, we've downgraded our growth projection to 6%. For FY26, we're looking at 5.9%. Yes, there are some temporary factors that are at play currently. For instance, the government isn't spending enough, or we had some issues with the last quarter. But what we are more worried about is the fact that, one, on the global side, it's going to be a much tougher environment with the Trump policies coming in on tariffs, on around immigration. So it's going to be a tougher global environment. And also within India, the urban pent-up demand that was there post-pandemic has largely dissipated now. And on the urban side, it is showing up in terms of the macroprudential tightening, which the RBI has done, is showing up in terms of lower credit growth and is going to impact demand. The other thing also is that be it in terms of employment, be it in terms of income, they haven't grown strongly. So add to that the fact that private capex has yet to pick up strongly in an environment of global uncertainty, in an environment of weak domestic demand. And then you put that together, and then you say, okay, what are the positives, right? And the positives are that rural demand should be better because we have, at this point, very good monsoons.
You kind of describe the picture. Let me just come in here. Can it be helped, the negatives, can it be helped through monetary or fiscal policy?
Oh, absolutely. I think for monetary policy, our view is that the RBI should cut tomorrow, right? Monetary policy has to be forward-looking. It has to be counter-cyclical. So we not only have the first cut on the 6th December policy meeting, but we have a deeper rate cut cycle of 100 basis points. On the government side, I think the capex run rate has been much slower than what is required for the year. So I think from the government side, it's actually pretty simple at this point. Ramp up spending to meet the targets that are already there for the FY25 budget.
Aurodeep, let me just go back to that. So you're saying a 25 basis points rate cut, not a CRR cut, right? Tomorrow.
We are also saying a 50 basis point CRR cut.
Wow. So you're saying 25 basis points repo plus a 50 basis points CRR. That's going to be a massive bazooka, right? Which takes me back to your overall note, because I think that's not just a knee-jerk call on the GDP. You're expecting India to see aggressive rate cuts in the Asian region as well. So just expand on that. And how does the RBI do this? How does it inject this big bazooka of liquidity in a rate cut at a time when inflation is trending above 6%?
I mean, we need to figure out what is contributing to that inflation, right? Once you take vegetables out of the CPI basket, inflation is at 3 to 4%. Core inflation has been low for a very long time. So the question is, if growth was strong, you could hold monetary policy tighter. But when your forward-looking forecast is pretty well anchored at 4.5%, and you're at a point where, I mean, the GDP print that we got of 5.4%, I mean, let's not kid ourselves, that is pretty shocking, right? India's trend growth is 6.5 to 7%. So that is not normal, which means that not only does the RBI need to downgrade its GDP forecast for FY25, which is at 7.2% currently, but also means that it has to reassess its confidence as far as the growth cycle is concerned. And again, the impact of the first rate cut now will only be felt in the economy around 6 to 9 months later. So, this is the time to do the rate cut because monetary policy, as I said, has to be forward-looking. The CRR cut is primarily because there's been a lot of forex intervention, hence liquidity out of the system, and so there is then the need to infuse durable liquidity. So the CRR cut comes from there, but on the policy easing, I think we need a pivot soon.
Absolutely. Government spending, Aurodeep, again, should not be any issue. I don't know why it should be constrained now, right? I mean, too much focus on the deficit. And I think this, I remember having discussions around the time of the budget, not just this one, but the previous one as well, when that's, government spending targets, etc., for budget estimates were brought down sharply. So do you think we will see a change in track there as well?
I mean, one is, actually, I completely agree with your view that there's technically nothing stopping the government now, right? So there is no election, there's no constraint on them. But I think there is also an issue of the institutional capacity to spend, to get all that money out of the door by the end of the fiscal year, given that we had a late start to the year. So I think on the RevX side, there's been some growth. We were really hoping that the October number for capex growth would be stronger because there was nothing stopping it, but actually it's still continuing to contract. So I think there is an issue in terms of sort of being able to drive up the spending. So a lot depends on the government sort of telling departments and getting this engine running again, because private capex isn't really in the picture. So much of this investment growth that we see in the GDP statistics is essentially reflective.
What's the number,
public capex?
Aurodeep, sorry, we're so sorry we're rushing you because we're hard pressed for time. But just on government capex, second half, what's the number or the pickup that you're expecting? Because the first half was contraction in government capex. Just leave us with the numbers that you've penciled in right now.
So the way I'm thinking about it is that, reaching 11.1 trillion rupees, which is the budget, may be difficult. So there might be a saving of $1 trillion or so from there. So our baseline view is that the government will probably get more capex this year than last year. So there'll be a year-on-year growth, but probably will fall short of the 3.4% of GDP or 11.1 trillion rupees, which they have budgeted in the FY25 budget.
All right, Aurodeep, we continue to track all of this with you. It's a great conversation. Thank you for joining us and looking forward to the next one. We'll see if the RBI does sort of oblige with a cut, although that is not consensus, and of course what the government does as well. 80 points, 85 points lower on the Nifty, 24,384 is where we're at.